looking forward to today's conversation.
Yes, and we are sorry to everyone, but we're finally live. We were just trying to get through live to our social media audience, and a good morning to everybody. We will be going through a bit of data today. We'll be going through the regular, we'll be going through a regular futuristic Friday data, and we'll also be going through inflation reports and digitizing Africa's next generation. So watch out for that little blockade in the way there. Digitizing Africa's next generation. But for the purpose of it, let's kick off and let's get started with our market roundup. Now, we did see yesterday that the Kwacha did drop yesterday again, 18.328. But in the final session of the day, we did see the dollar get stronger a little bit, kind of just reversing the gain. So we don't know if we're going into a day where there is a bit of trade upwards on the dollar. So we'll be looking to see if that was just one session or if we're going to be seeing that being the reverse. And that was just a short-term drop in the value of the currency back to about 18.38, and that became the floor that we were dealing with. Now we are seeing that in the last 30 days, the dollar is up it's up 6.38% and up 1.58% year to date, but still in a bit of a buying position because of the strength that has been building up. We did see the all-share index yesterday of the Lusaka all-share index move up to 8,367, a new all-time high, up 1.74% yesterday on the fact that Airtel was up 25% on yesterday and is up 73% year to date. We'll be talking about that a little bit later. And up 14.03% year to date. We did see also the bond index move up 0.07% and 0.34% in dollars yesterday, while interest rates skirted back down to 24.1209%. We did, as I said, we did also see the rand shift down by about 1.12%, down 2.03% year to date. So therefore, the strengthening of the currency, we will see whether this is continued or whether it was just a momentary dump of dollars that actually came into our economy. Finally, we did see, as I said, we did see that the bond index is up 15.28% year to date, while our US dollar bond index is also up 12.48% year to date in dollars and up 0.34% yesterday, with interest rates still up 0.48%. Copper yesterday was down by 0.58%. Softer news coming out on the rest of the economy, though global economy did get pushed up yesterday by the United States, moving up by 2% in GDP. 1.39%. We saw oil move upwards, while gold is down 1.47% on the news that we might potentially be skirting a recession risk. So global growth in terms of GDP activity. However, there is a little bit of weakness in the global news on the fact that the Federal Reserve may keep hiking interest rates on strong GDP data from America, stronger than expected GDP data of America of 2.4% GDP growth. Wealth insurance assets such as Bitcoin dropped about 1.8%, mainly due to the strengthening of the Kwacha, and also Ethereum down 1.5%, with gold also down 3.29%, all down mainly due to the strengthening of the Kwacha against them in dollars. These were slightly stronger, though you are seeing a bit of a sell-off in cryptocurrency happening right now, even in dollars. Year to date, you're still seeing about 79.22 when it comes to Bitcoin. In terms of our broad asset markets, we're still looking at a strong broad asset market where we're still looking at a defensive position where the bond market is stronger than the stock market right now, 15.3% on the bond market returns, while we're seeing 14% on the stock market. Currently, we're still seeing USD. The USD only up 1.6% year to date. And also gold is up 8.1% year to date in Kwacha. Now, cryptocurrency, also Bitcoin up 79.2, with Ethereum up 58.1%. But remember, those are highly risky assets that we are building into. So that is kind of where we're picking up from. And then our four horsemen, of the different sectors of the global economy and the headwinds and the tailwinds we're looking at. Inflation data in South Africa is showing us that we are seeing some sort of tailwinds coming in to support it, in that inflation is declining in South Africa. PPIs came in, which are leading indicators of inflation, came in negative yesterday in terms of month on month, while year on year PPIs came in at 4.8%. We also saw core PCEs in America prices come down to 3.8%, and we're still waiting on Tokyo inflation. We did also see German consumer, but unfortunately on the income side, we saw German consumer consumer climate drop, but we saw Spanish retail sales up, Spanish unemployment come down, American jobless claims dropped below dropped below 1.7 million for the first time since March. And we saw a US GDP come in at 2.4% higher than the 2% that we saw in the previous year, with real consumer spending up 1.6%, a little bit slower than the first quarter, while retail inventories are up 0.4% from the decline that they faced in the last quarter. In the industrial sector, we did see Italian business confidence drop, while we also saw Italian consumer confidence drop, while we also saw core durable goods rise in terms of their month-on-month orders, with pending home sales coming down negatively, with interest rates all still registering upwards. So our four horsemen are showing us that inflation is cooling, interests are still elevated, income is starting to see some spots of growth. We are starting to see some GDP growth coming into the picture, with industrial still a bit weak and slow. Now remember, we are expecting a 1 quarter 3 way rise in the pump price by the end of this month by the ERB, mainly due to a 6.35% rise in Brent prices. Now, yesterday we did get GDP data. So for everyone who's with us today, remember that, so not GDP data, we did get inflation data coming from Zambia Statistics. And it is that day where, following it, I give you my analysis of it. Now, my summary I am going to say is that, one, we did see that July inflation did jump to 10%. 10.26% back into double-digit inflation, 10.26% from 9.77% due to the largest single-month jump in breakfast meal of 10.93% to a record 226 kwacha for a 25 kg bag. So it was really just Nshima inflation that we are going through as a country. Yes, that is a real thing. Nshima inflation drives most of it. Or in Jan. Now, what we're also seeing is that July month-on-month inflation was up 0.89%, which is higher than the 0.8% that we had in June. And monthly inflation rose and came in above the expected, what we call the expectations curve. And that showed that, and that was due to both food and non-food inflation rising above the 10-year average expectation curves. The main drivers of annual inflation going back into double-digit levels was due to record inflation in food, and specifically breakfast meal inflation, which rose up to 39.75%. So in other words, a bag of a mini meal is up 39.75%. This is the highest level of annual inflation in a bag of mini meal since May 2020. Global mark, however, we're not facing global inflation around the world, so we're not importing inflation. The price of things around the world is still coming down, so we are seeing cheaper things coming from around the world. But unfortunately, it's our weak currency and our domestic supply chains that are leading to high food costs, and that is a bit concerning for Zambia. Because this is the time when we're supposed to have lower inflation, meaning in our books, I'm seeing inflation this year probably ending somewhere between 11 and 12%, if not 11 and 12.5% actually. So there's a potential for inflation to get up to 11 up to 12.5% by the end of this year. And I know that BOZ and everyone has it around 9%, but according to my projections, we're looking at somewhere around 11.28%. That is what we're probably seeing. Now, if you're looking at the inflation chart altogether, you can see that yesterday's inflation reads, you did see that food inflation ticked up to 12.07%. So that was the big jump. Now, we did see a minor movement in non-food inflation from 7.78 to 7.8. So most of this move was shifted by food inflation moving upwards. And that's what moved it from 9.7 up to 10.26, which is the highest inflation that we've seen, at least in the last 12 months. So inflation is currently sitting at even a 12-month high, meaning that we're getting hotter than normal inflation, and it is being driven by food prices. You can see the red bars are what the 10-year average monthly inflation for that month is. Okay, so this is what we call our expectation curve. The red bars are the 10-year average. The black bars is what happened, is what actually came in. And as you can see, since January this year, we've been getting inflation that is higher than the 10-year average. or the 10-year, what we call the expectation for that month. So we can see that about 0.89% is what came in yesterday versus 0.44%, which is what the monthly benchmark is. So we came in double what that was. Where did that come from? Food inflation was only supposed to be 0.26%. This is supposed to be the least inflationary month of the year according to the expectations curve. And if you look at the last 2 months, food inflation has come in way above that. In fact, it clocked in about 1%, 4 times the inflation that we're usually expecting in terms of that, meaning we're getting hotter than normal inflation, and the end of the year we're likely to see a run up in inflation. Mainly because that's when food demand really kicks in and we're out of season of growing things. So that's the time when we start growing our food, and therefore we don't have as much on the market. This is when we're supposed to have a lot of crop on the market, leading to less consumption. Other news where we're also seeing it is on the kitchen table prices. Monthly movements on kitchen table inflation, as you can see, 7.15% grain inflation. Yes, in the last month, we saw grain prices, roller meal, roller meal, breakfast meal, those things are up on average 7.5% from last month, not from last year, last month. Okay, so that is a record movement in that area. As we can see, we did get a little bit of inflation in the price of eggs, and while we did get a bit in the price of Kapenta, 1.28%, the rest of them are pretty much low and non-existent. As you can see, as I was pointing out, the mini meal inflation, this is the chart of the last 12 months of annual inflation rates of a 25 kg bag of breakfast meal, which has moved up from 14% where it was last year to 39.75%. This is absolute pricing pressure coming in on a bag of mini meal. And this is good for the farmers, but difficult for the consumer at the moment, because this is the biggest part of the chunk. We also are seeing, as we're seeing in terms of grain prices, they also are still elevated around the 29% range. So you can see 29.91%. This is the highest inflation that we've seen throughout the year. 32.21 was the last time we saw anything this high, which was in December 2022. As you can see with non-food inflation, we did see that non-food inflation came in slightly above the expectations curve, 0.7% versus 0.49%. So it is food inflation coming in higher than expected, which is causing a lot of the higher inflation and the stickiness in elevated inflation. Now, if you're looking at where the biggest mover of inflation for this last month was, look no further than clothing and footwear. Clothing and footwear was up 1.6% monthly in this July read. And that actually pushed some of the numbers up. So, Stephanie, it was your people, your fellow shoppers and your fellow clothing sellers. But mainly, I think I can attribute that also to things like cost of bringing things in from either Dubai, China, or South Africa, where we have had a weaker or more volatile currency, which is pushing the price of apparel up. Remember, we don't produce clothing. So 1.6% movement in clothing. That was the main driver as well. Annual inflation, though we are still seeing, it is food inflation up sitting at 12.1%. And the next one is still transport inflation, which has dropped down to 10.6%. It really was clothing and footwear was the only one that, aside from health, which rose. Health inflation is up from 8.4 to 8.8, while clothing and footwear inflation is currently sitting at about 7.9%, with restaurant inflation also up 10.6. Now, what were the key drivers contributing to inflation? It really was number one, clothing and footwear. 97. It was one of the biggest drivers of monthly inflation changes, while we saw food inflation pushing up as well, and also housing and utilities. Those were the main drivers of inflation, while it was being pulled back by transport costs from the previous month's hike, from the previous month's reduction, and furniture and furnishing costs, which were also pulling back down. Now, in terms of annual inflation being moved up to 12%, being moved up to 10.26%, that was all the work of being done by food. Food inflation was the main reason why we saw the annual inflation move up. So this is a chart that we use to look at what was the key influence in inflation. It's one developed by our team in the back end to actually show you that it was mainly food inflation that was the key driver. One of the things now, in terms of on the global markets, we are seeing now, we're looking at, are we importing this inflation or not? if you take a look at the price of things, the only thing that's up is sugar, and sugar is something we are a net exporter of, not a net importer. Everything else, except maybe tea. Tea is the only thing, tea and coffees are the only thing that are up 1.1% on a month-on-month level, and meat is up 0.1%, but everything else is actually dropping in dollar price. Now, on a year-on-year basis, sugar is up 29.7%, and everything else is down. Meat is down 6%, dairy is down 22%, cereals are down 23%. So you can actually see mainly there is a drop in prices across the board. And if you're looking at even the indices, you can see that food inflation is still down, is negative 1.4%. The global commodities inflation is down 1.8%. It's only metals inflation, which we should actually be benefiting from. So in the drop down of all of this, I'll say that even in the optimism of a credited deal, there is still some headwinds of domestic supply chain constraints causing inflation. And we're currently in a weak position of elevated inflation and weak growth at the moment. Remember that growth expectations are down to 2.7%. So inflation still remains between 9 and 11%. I'm seeing it end this year actually between 11 to 12%. And what is supposed to be a season of lowering inflation, which is what we call the inflation valley. So disappointing inflation numbers coming in now is already putting at risk the future of the ending of inflation, the inflation ending in single digits this year or close to single digits. In addition, the nation is actually facing lowering GDP growth due to mining, electricity, and agricultural recessions. Remember that came in the medium-term green paper, and this leaves the economy in what we call stagflation. And therefore, this leaves the economy in where we call a stagflationary position of slow growth and high high inflation. So in the short term, I would tell you that your investment options still look like your 2, 3, 5 year, and if you want to add in a 1 year bond as well for nimble, the 1 year treasury bill or 364-day treasury bill. That is your main ones. And if you're looking at being an equities investor, look for businesses that have cash flows. In other words, on the stock market, you're looking for things that have growing cash flows, they've got declining leverage, and they've got strong market power. In other words, if they raise their prices, they do not lose market share. They do not lose customers. That's what you're trying to avoid. But it is, we are still experiencing higher than regular inflation. I would obviously then speak to, I don't know, Steph. Well, I don't know if Steph is back, but I don't know, Steph, what are your comments on the current inflation situation? Okay, so I think we'll be getting into our next part of the conversation, which is back into our deep dives for the day. Now, a couple of deep dive stories that we have picked up for the day is National Breweries revenue did move up by 9.77%, but losses increased by 98.39%. So we almost saw a doubling of the losses that they're experiencing. The company posted an operating loss of 194.3 million kwacha against 82 million kwacha the prior year, resulting in a loss after tax of 237 million kwacha versus 120 million kwacha the prior year. The loss per share is 3.7 and 1.7. Most of this is account of higher financing costs and FX losses. They are trying to implement a turnaround strategy where they're offering new products like Chibuku Super Banana. Okay, banana flavored Chibuku, and they're continuing to expand their depots and footprints and strategic areas to try and fight and deploying competitive packs to fight competition and congestion in the trading spaces of traditional African beer. So one of the problems they're having is they're not only having a bottom line problem of forex losses and high costs high costs. Some of the things that they're also facing have got to do with the fact that they are dealing with competitors, especially from the illicit sector. Now, they did see that the second half of the year, they did close with 66% higher volumes. In the second half of the year, 66% higher volumes and also 28% than the prior year. And this was mainly due to affordable offerings. The company is continuing to face headwinds from a weak kwacha, which is leading to packing materials becoming more and more expensive, increased prices of maize. So you can already see that maize price is going to affect your national milling, your national breweries, revenue and profits. Impact of petroleum products pricing, which has led to higher distribution costs, and excise duties regime, which was increased back in 2022. So you can already see these factors are increasing the cost of doing business for Chibuku products. And therefore, that becomes a problem. Now, the prospects they have is they're trying to diversify their portfolio with different flavors, as they talked about banana flavored Chibuku. They're talking about expansion of distribution footprints to improve the customer service, and also trying to focus on increasing the volume performance and also developing local suppliers. One of the things they're trying to get rid of as a company is the fact that they're importing packing materials for their products, which is actually coming in much more expensive. And remember, they're trying to sell affordability. Their product is a low price product, so they don't have much wiggle room and don't have much margin space in order to operate. So as a result, they're actually getting hit very hard by any slight movements in their costs of production. So they're trying to actually bring in local producers to be able to do that. So that actually might be some positive. Now, one of the things I would say about National Breweries, which I will say off the cuff a bit, is that I think this company also needs to reconsider diversifying not only its products, but diversifying its customer base. And I say this because I once worked with a Jamaican, a gentleman from Jamaica, Zambian though, he's from Jamaica, who's actually trying to work on more up-class versions of Chibuku, making what you called cocktails with Chibuku. I think we were calling them, we threw out the name shake tails. What I was trying to say is that as a product, they need to figure out how they can get into the upper part of if they can get into the upper part or of the market, the premium market, by actually maybe some way, shape, or form creating a upper class version or giving Chibuku a facelift, kind of like the way Maheo did as well. If you look very carefully, a lot of these Maheo companies actually managed to improve the look of Maheo, that it now became more of a middle class product than it was a lower income product when it used to get sold on the streets. Now it's in stores properly, and it's something that people are proud to walk out of the shops with because they really remarketed. Look at all these shake and sip adverts and all these shake adverts and all these super shake and Amasip and all these adverts. You realize that they've actually branded these products a bit more up class. And what that does, by the way, is it allows the product to be a bit more expensive and it gives them a bit more margin. And I think one of the things Chibuku may probably have to go through is that it doesn't have to abandon its lower income, but they do have to reconsider a higher income version of it to then maybe appeal to a higher margin group. And the good thing about alcohol products is they are price inelastic. Okay, so they probably need to sit down with maybe a team of chefs or something. That would be, if I was in that position, trying to see this company that is constantly going down in a high inflation, high interest, slow growth environment. Having products with narrow margins are gonna get pulverized. Okay, we've got a rising inflation market. We've got elevated petroleum costs. We've got elevated. We've got gummed up supply and a weak currency that is still struggling to get back its strength. This moment, you're going to see stocks like National Breweries continue to take a beating day after day, time after time. So in order for that stock to actually come back stronger, they probably need to look at diversification of their customer base and doing what's called a market expansion. How do we take this product by just slightly reconfiguring it, maybe rebottling it, reflavoring it, working on it, adding things, I don't know, and they're on the right track with things like strawberry, banana, coffee flavor, whatever it is, trying to find ways to tap into the new market. That's where I would see the future of this product diversifying into a more higher margin market that can compete with the lower margin market, which has been its base. Because currently they are experiencing sales growth and they are experiencing growth altogether, but they're getting whacked by the economic environment, which is hitting the bottom line horribly. Because yes, revenue expanded by 9.7%. Sales volume was up 28%. But bang, we actually saw the bad side of this, that losses went deeper by 98%. Why? Because the problem is not at the top end of the company. The problem is in the middle. So they need more high margin offerings to expand the company and to actually push it out. That's where I would look at the future of that company being. Now, let's get back to some other news that we saw on the stock market yesterday. Is that we saw Airtel shares also jump. Airtel shares climbed to their highest since May 2020, recovering all their pandemic losses. Airtel shares jumped 25% yesterday in trading, closing at 30 kwacha for the first time in 38 months, thanks to a year-to-date rally of 74%. This has been driven by a mix of optimism in the telecom sector, which is set to grow 40% this year, and backed by positive results in the past years, culminating in strong dividends paid. Now, the company also has regained its 3.2 billion valuation after facing threats of even dropping out of the 1 billion kwacha club, which is what we call our exclusive mega cap club. Now, Airtel stocks also jumped. The Airtel stock jump also pushed the Luce All-Share Index up to a new all-time high of 8,363.33, up 14.03% year to date. Now, here's a quick chart that actually shows the history of what we're talking about. If you look at from September to January 2022, September 21 to January 22, we saw Airtel shares drop down by 39%, but we've seen them since recover from December 2022 to July 2023, where they're now back up 74% and back stronger than ever than expected. So we're actually back to where they were back in May 2020. That's exactly where we're seeing it. And you can see it from the financials. It's a fundamental shift. Airtel financials have been, revenue has been growing by about 24%, with net income up 300%, it was up 300% the previous year, and up 32.9% last year. We also saw that in terms of the market cap, it's up 8.7, but now it's actually up 74. Dividends per share in terms of Airtel is now sitting at about five kwacha 50. That is very high for them. So we're actually starting to see a strong dividend that was issued out, and earnings per share also is now starting to move up to about 8.6. We are starting to get a strong shift in earnings per share, and we'll see as we're getting to the share price itself. Now, we shouldn't risk this becoming an overpriced share, but we're getting close to a full valuation EPS. Now, in terms of the share price, we are way above that 18.5. That's where we were at the beginning of the year. Now we're moving to about 30. And now even our price to earnings share, that's been the main one. Our PE is still at about 2, which is way less than the full valuation of 7. Remember, it's our PE ratio that's important. And we're seeing it at about 7. So it should be getting close to about 7. So currently it's about 4.09. So there's still room for the Airtel share price to still go upwards. And this is why you're still seeing some positivity, and even price to book value, it's still relatively strong. Cash positions have been going a little bit in the negative, but operational cash flow has actually grown by 25% last year, with CapEx spending in Airtel actually driving some of the activity. So that's actually some of the other positives that we're seeing from the stock. Other things we are seeing from the stock market yesterday is Zambia Environmental Agency exceeded its target for environmental impact assessments by 30.4%. This has brought in projects of about 14 billion. Now it's also looking at putting a lot of its services onto the government bus. It actually has received some cash for that. Other thing we did see yesterday, I think there was a question on DB's on Development Bank of Zambia, where we've seen that 98.8% of Development Bank of Zambia loans were non-performing, with material weakness in underwriting and loan management. Now, part of the news we've also seen is that there was poor loan recovery, which equals low income generation capacity. DBZ has not even been lending for the past 3 years, and we've seen it obviously struck by significant and by exposure to prominent and influential persons, leading to a lot of the defaults. So it's a lot of bad lending due to people, and this is a company that's been bailed out over 19 times since, and that rounds up some of our news. Relatively. Now, we also did see that South African PPIs did drop to their lowest since March 2023. March 2020. And we've seen that South African PPIs has actually dropped to about 4.8%, since March 2022. Not 2023, that's a bit of a typo there. And so this is actually putting pressure on the Reserve Bank to finally put on hold any of its rate hiking ambitions. Crude oil did jump up yesterday due to a stronger US GDP and also Russian and Saudi oil cuts, which are expected to start this month. So in other news, we did finally get And winding up today, we did finally get some data from the Zicta ICT survey, which is showing that the face of ICT, in other words, the face of technology or the technology and communications mediums that we're using is changing. As you can see, radio now has dropped to about 35% nationwide in terms of household ownership, from 45% in 2015 and from 60% much earlier in this decade. And ownership of televisions has dropped from 33%, it's just slightly risen, from 33% to 36%. Computers are up from 7.1 to 9.5 slowly, but it has been the mobile phone, which is up from 64% to 80%. And we're seeing even access to Wi-Fi is up from 13% to 33%. We're getting a high proliferation of all of this. Mainly, as you can see, urban radio is still at 45%, but the key driver that I'm looking at here is Wi-Fi and mobile usage. 92% of urban homes have got mobile phones, while access to internet services is now up to 59% in urban houses. And access to a computer is actually up to almost 20%. So almost 1 in 5 Zambian homes has got a PC in them. So that's actually quite a big change. Now, if you're looking at some individual level findings, we're also looking and finding that people who have at an individual level, we are seeing that access to mobile phones, about 63.3% of the adults have got access to mobile phones, up from 51% in 2015 and up from 53%. Access to mobile cellular phones, ownership of a cell phone is about 51%. Proportion of the mobile phone ownership that has smartphones is still about only a third. So we're really looking at about 20%, less than 20% of the Zambian community still uses smartphones. And individuals who know how to use a computer is now at 11.8%. Know how to doesn't mean they own one. And even later on, we're still seeing that out of all of this data, we're still seeing that access to social media is now at about 87% among internet users. So remember, internet users are a different set of statistics. But we're seeing amongst internet users, 87% of them have access to social media, 11% of them have access to e-commerce, and only 43% of them are aware of the risks of doing things online. And what individuals have access to the internet is about 25% of the Zambian population. Now, I think one of the things that caught my attention here are digital skills. Because this is where we truly need to develop as a country. Now, we're looking at people with the ability to use computers. That's only about 11.5% of the population. Sorry, that's only about 11.5% of the population who have access to digital skills, who have access to a computer and therefore users of digital skills. Now, if you're looking at users of digital skills, you're seeing that people who can write code, only 9% of computer users can actually write code. If you're looking at people who can activate, who have knowledge of active security and privacy settings on social media platforms or web browsers, only about 40% of computer users can do that. But if you're looking at access to digital financial services, 87% of computer users can do that. People who can use spreadsheets, about 20%. People who have the ability to send an email, 1 out of every 3 computer users. That's a bit sad. And moving a file, 54% only. Not 100%, 54%. So we really have to make sure that we really do push computer literacy in this country. It's actually quite important to do so. And if you look at some of the barriers that people are facing, this is data that we picked up on. If you look at some of the barriers to smartphone ownership that people are facing, the challenges that they are facing is that most of them is the cost. That's number one, and the lack of use of device. When it comes to digital financial services, lack of money to be able to do it. Reasons for not using the internet: 1 is I don't know how to use it. And 2 is I don't have a device that can access it. So people just don't even use it because they don't know. And incidences of online of weaknesses, the biggest one is fake news. The second one is scams. And we're seeing illicit video activity. Finally, the last piece of data that we'll look at here from the Zicta ICT survey before we close off is that what are the challenges people have with using commerce? The number 1 is delayed deliveries. Number 2 is just misrepresentation of goods, and 20 is under-delivered goods. And barriers to using digital financial services is we don't have enough money, or they just haven't registered. Those are the main ones, and the preference to transact in cash. Now we're going to talk about the future of connecting Africa, but we'll leave that one for Monday. And to all, we will wind up today to give everyone a rest for the day. There is a future there's a future interview that we have. We're going to see with Strive Masia on Monday, where we'll be going into it before we get into our Mindset Monday. So to everybody who's been with us today, you have seen some of the moves on the stock market. You've seen some of the moves in general. Thank you very much for joining us. I wish you all a blessed and wonderful weekend.